So if you're buying a home and you really hate where interest rates are, I've talked before about how there may be like down payment assistance programs for you or permanently buying down your interest rates, but let's also talk about another option, which is a temporary interest rate buy down. The way a temporary interest rate buy down works, you are getting a seller credit that is going towards buying down your interest rate to usually a point to 2 or 3 points lower for a short amount of time. So for example, there's different versions. A 1.0 buy down would mean you get a 1% lower interest rate for your first year, and then you go back to your regular rate after that. 2.1 buy down means you get a 2% lower interest rate for your first year, 1% lower interest rate for your second year, onto your regular rate from then on. Or the big one is the 3-2-1 buy down, where you get a 3% lower interest rate on first year, 2% lower on second year, 1% lower on third year, onto your regular rate. This is one where if you've had any new construction companies that you've talked to or financing with them and they're offering temporary lower rates, that's usually what they're using. So to give you an example, let's say you get a seller credit and you want to use it towards a 2-1 buy down. You decide to lock in your regular rate at a 6.5. You're doing a 2-1 buy down. So for your first year, you're going to pay as if your interest rate was a 4.5. For the second year, you're going to pay as if your interest rate was a 5.5. And then in year 3 on, all the way to year 30, unless you refinance, you'll pay at your 6.5% rate. Now, let's say you've locked in at the 6.5 for your regular rate. You're in this 2-1 buy down period. So you again got 2 years of these lower payments. Rates suddenly do come down, which we pray, but has not been happening. You can refinance during that period or any point after if rates come down and go ahead and get into those lower rates, whatever they may be at the time. So let's say you're in a 2-1 buy down, you're in the second year, you've been paying as if you have a 5.5 interest rate instead of a 6.5. Rates actually do come down and you could lock in at a 5.5 for the remainder of your loan. You can go ahead and refinance whenever the rates make sense and get into lower interest rates. On the flip side of that though, I do warn all my buyers, really hone in on what your permanent rate is going to be after these temporary buy downs, because if rates don't come down and you decided to lock in a really high rate because you didn't want to have to pay anything to buy down your permanent rate, that's okay. But if when your temporary interest rate period ends and your rate can't come down significantly, you may be really unhappy with your payment. A good example is you decide, okay, well, I'm going to lock in at a 7.2 for my permanent rate because it's par rate. It doesn't cost me a dime to get to that rate. Now I can use all of my seller credit towards this temporary interest rate buy down and my remainder of closing costs, and I don't have any interest rate buy down costs that I incur. Let's say you did a year buy down using your seller credit. The year ends, rates are now still at a 6.8, which they have been for a good portion of this last year. Going from that low 7 to that really high 6 rate would not make any sense. It's not going to save you very much per month. You're talking usually less than $100 per month, and you would have to pay closing costs all over again. Lender fees, attorney fees, all the things. So you're going to take thousands of dollars out of your pocket or out of your equity to barely change your interest rate. So when I'm doing temporary rate buy downs with my clients, I am really going over, okay, what will that permanent rate look like for you? So that way when this ends, if you don't get the ability to refinance, if rates haven't come down, you're still okay with your payment. The biggest benefit of a temporary interest rate buy down is, again, the temporarily lower payment. So what's happening is the amount that you're saving per month, which again can be hundreds, for the amount of time that that temporary buy down is going to last, that is what the seller credit has to be. And it's held into an escrow account. So when you make your payment to your servicer, let's say again, you're doing a 1.0 buy down and your regular rate's a 6.5. So when you pay your payment to your servicer for that first year, you're paying as if you were paying a 5.5% interest rate payment. They're then taking that difference that you're saving out of this escrow account where the seller credit sits and applying it. So the regular 6.5 payment has been being made for the whole time. You're just paying the temporarily lower amount and they're taking the difference from the seller credit and applying it. So again, that is the main benefit of the lower payments for however long you could get enough seller credit to do. It does take more seller credit to do a 2-1 buy down or a 3-2-1 buy down, because again, the difference in the regular payment and that temporary lower payment for that amount of time is what the seller credit has to cover. So you may not receive enough of a seller credit to do a 3-2-1 buy down. You may only receive enough to do a 1-year temporary interest rate buy down or a 2-year. Just really depends on your seller credit. But the main benefit is obviously the lower payment. The downside is you've now mentally been making a lower payment for a year or 2 years or 3 years. But that comes to an end, right? That comes to an end once that temporary interest rate buy down period is over, and now you're making that full payment. And mentally, the question is, were you actually ready for that payment? Or is it going to feel really gross to now be making this payment? So I tell everyone, if you're doing a temporary interest rate buy down, utilize that time wisely. Take that difference, really start paying down on credit cards or debts or car payments, whatever you have, okay? Because this is technically money you would not have had, right? You would have been making your full mortgage payment like normal if you were not in this temporary interest rate buy down. So if you're saving $200 a month as part of this temporary interest rate buy down, it's not like $200 of free money. I mean, you could think of it that way, but that's not the best way to utilize it. Take the money that you're not having to pay into your mortgage every month for that temporary time and do something with it. Put it into a high yield savings account and mentally assume you're making your regular payment and take that amount out of your bank account. Use it towards paying down debt. If you don't have a lot of debt, you could also take that extra money that you're saving, that you're not having to pay, and put it into making an extra principal payment or two, which cuts out years and years of interest. But what I warn everyone is, please don't, because you're saving $200 a month, just go blow $200 on other stuff, because you then have created a lifestyle where that's what you're used to, and then suddenly that shoe drops out on you when that comes to an end. So utilize it, do it as a benefit to yourself, take that extra money that you would have had to pay, and you will soon, and use it towards something that benefits you financially. If you have any questions though about temporary interest rate buy downs, how to use them, how to ask for them from your agents, how they work, just reach out.